Hi there, this is Greg Towner with Parallel Financial Partners, and welcome to our monthly Outlook call. Let's go ahead and jump right in. If we look at what we're going to cover this month, we want to take a look at the price trends both in the US and internationally. Going to take a look at a little bit of softening in some of the economic data, but how the long term is still looking good. Compare stock valuations to bonds and other alternatives, and then look at a really interesting chart emphasizing why we always say avoid the noise. So let's go ahead. Now, we always like to start off with the current price trends of the market, take a 3 to 5 year view of things. If we look here, the markets, this is the US market, S&P 500, still in a nice uptrend. Last time we spoke, we pointed out that we've kind of gotten a little bit extended up here away from our major moving averages. We've had a little bit of a consolidation to correct some of that, about 3% pullback, not much. We can, still have more correction and still be well within the uptrend. So nice uptrend there, and that's what we like to see. Now, if we move to international, we've pointed out in the past that there'd been a long-term or really a more intermediate-term downtrend in some of the international stock markets, and that we were seeing a little bit of a turn in that. Over the last number of months, that turn has really started to begin into an uptrend for international. We've also had a little bit of a correction here recently. But it looks like this uptrend may have quite a bit of time to go still. It's still early on. International markets are a little bit more cheaply valued. We've actually been looking for opportunities to add to international. So we like the uptrends that are beginning in many of the broad developed as well as emerging markets. Now, we've talked for months now about the economic data here in the US, how it's been really strong. Now, it's importantly been exceeding expectations. Now, this is the Citi US Economic Surprise Index. When the numbers are up here, basically data is coming in better than expectations, which is what you like to see. Now, recently we've had a few economic indicators come in a little bit soft, a little bit below expectations. And so you see a sharp drop here because expectations had kind of started to catch up to reality. So I think that's part of the reason we saw a little bit of a pullback in the market. Things have maybe gotten a little bit ahead of itself. But this indicator tends to be a little bit noisy, a little bit shorter term. And so we're not too concerned about it, but it is definitely something to monitor. But what we do like to see is as we look out longer term, this is the leading economic index, or commonly called the LEI. This looks out further, looks at a lot of different economic data. And what we've seen over the last 30 years or so, really, is that normally this peaks about a year and a half, somewhere in that zone, before we go into recession. So if you look at where we are now, luckily we can see that we're still moving up in the LEI, have not appeared to peak yet. So from a longer term perspective, economic data is still solid for us. Now, another thing that we've talked about is valuation. Now, certainly a lot of investors out there are concerned about valuations. They hear a lot about how stocks are overvalued. We're not going to say they're cheap, but if you look at, for example, compared to bonds, now this gray bar, there's not really a specific PE or price to earnings for bonds, but this does its best estimate of it. The bonds are pretty richly valued still. Compared to historic, you can see bonds are pretty high. If we look at the blue bar, stocks looking back over the last 12 months, we're pretty much in line where they've been for the last couple of decades or so. Not too far off from where they are for part of history. So again, not real cheap, but we don't think valuation is so high that it's of great concern, particularly when you compare it to bonds or cash, which are really the two primary alternatives that investors tend to look at. And we think this is a great chart here. This looks at the 10-year rolling return for the S&P 500. So this takes into account the last 10 years. You can see if you go all the way back to the 1930s and the Great Depression, we had a brief period where a 10-year stretch was under zero. You had negative returns. The only other time we had that was here in the financial crisis, less than a decade ago. Of course, we go back to the late 90s, the tech bubble. We were way up here. Coming out of the Depression, we had a big run in the 40s and 50s. Again up at that 20% 10-year rolling level. Right now, we're about halfway through, maybe not quite halfway through. Of course, there's no guarantee when or if we'll go way back up here, but we just thought this was a good way to point out, hey, yes, the market has had a nice run for the last 8 or so years, but that doesn't mean it can't run further. Whether we have corrections along the way, of course, that may be, but there's still potential, secular move with a number of years ahead that we see as a possibility. Now, this is a chart that we really think is important because particularly in this day and age where there's so much attention in the media, whether it be on TV or newspaper or online or what have you, of all these, headlines, reasons to be afraid, reasons that are seemingly that you should sell stocks or, get really conservative. This chart here is looking back to the lows of the market in March '09. Stocks have gone up, 250% during that time period. There's all these, scary sounding type headlines during that period. We get more and more of those today as the media grows and grows. So we just, as we've said a lot, it's important to avoid the noise, try to ignore a lot of these things that many of us can't even remember what these were. And at the time, they seemed really scary. It doesn't mean you don't have a risk management plan in place. It's very important to have that because you never know when a small correction could turn into a major correction. And depending on where you are in your investment cycle, you need to be aware of that. But more often than not, it's important to avoid the noise and just stick to what your long-term plan is. So really, in sum, what we see is U.S. and international price trends are still pretty healthy. We've had a little very modest correction here recently. It could correct more, we don't know, but we still think the price trends are pretty strong as we look out forward. Economic data has gotten a little bit softer of late, still most of it coming in well. Expectations are probably getting reset a little bit. That's fine. We don't see any major red flags as we look out with the leading economic indicators. Stocks, again, not super cheap, but when you compare them to a lot of alternatives, we think it's still going to attract investors' money, both institutional and more on the retail side for quite some time as people look for returns, look for yield, and that sort of thing. Still think stocks are attractive. And importantly, avoid the noise. There's always reasons to sell, but stick with your plan for the long term. Well, from Parallel Financial, thank you for joining us, and we look forward to talking to you again next month. Thank you.